name is Fernando Parra. I have the great privilege of serving as director for the Institute for Family Business here at the Craig School of Business. I also am an assistant professor of accountancy. I recognize some of my students today. That's just for fun and for kicks. We have a wonderful panel today that are joining us to discuss some of the tax and legal considerations for family business. There's a great group of professionals from Assemi Group, starting with Ivan Caldwell. So I have a very long introduction for you, Ivan. He is the Chief Tax Officer for the Assemi Group. He graduated with a JD degree from the Southwestern Law School in LA and an advanced degree in tax law from Georgetown University Law Center in Washington, D.C. Ivan advises clients on tax consequences of buying, selling, and restructuring companies. He performs due diligence, examining the potential tax risk associated with acquisition targets, and creates tax-efficient transaction structures. He has also served as an instructor in graduate accounting courses, in specifically teaching tax accounting and corporate taxation. He has an extensive history of cross-border and domestic transaction advice, including advising private equity firms, domestic and foreign strategic buyers, and other investors in connection with structuring acquisitions and dispositions and so forth. He's also licensed to practice in DC and the state of California, and where he has earned the certification as a specialist in taxation law. That is just one of that's the brief introduction. He is actually joined by two of his colleagues. We have Ivan Medrano, who not only shares Ivan's name, but he's a graduate student that just recently completed his internship at Assemi Group. So congratulations on that. And he is going to share some of the experiences that he learned at Assemi Group working for their specific projects as well. And then Nicholas, your last Nicholas Howes. He's a Fresno State alum with more than 4 decades of experience in tax issues. And we really appreciate you guys sharing your time and sharing this knowledge with our members today. So I give it up. Yield the floor. You're welcome.
I'll move to the computer here. So thank you for coming. I'm very pleased to see all the interest in this topic. And admittedly, this topic is very incredibly broad, right? Tax and legal considerations for family businesses. It's a very broad topic for such a short period of time. So we developed a presentation. It's very limited, and it would be pretty useful if we get questions from the audience, so we can sort of discuss specific issues that are interesting to you. But I just want to back up a little bit, and for already a great introduction, I wanted to add a little piece about how what interested me in tax, why I got into the field of tax to begin with. And that happened back in law school. When I went to law school, my ambition was to become an insurance defense lawyer. That was sort of what I was going for. And when I was in law school, 2 things happened. You might hear accent. Right? Accent is a Slavic ethnic background. Legally changed my name, by the way. If you look for Ivan Caldwell in California State Bar, you won't find him. It's John Caldwell is my real first name. I'm going by Ivan for now. But anyway, in law school, I discovered 2 things, which kind of struck me having come from Soviet Union. One of them was the sort of constitutional system in the United States, the separation of powers, and really rule of law. And it struck me again as a student in law school that in disputes between the federal government, which is the most powerful entity on planet Earth of all time, right? Federal government and a taxpayer could be in a controversy, right? In a political fight, and the taxpayer could win. And again, coming from Soviet Union, where government basically controls and rules everything, every little aspect of life, to see that the government can lose to the taxpayer was just amazing to me. Like, wow, America is the best country. For many reasons, this is one of them, right? And not only that, I wanted to be that person. I wanted to be that person who stands between the taxpayer and the government. I really thought that And I want to say that the loud word that comes to mind is accountability. I want it to be accountable, keep the government accountable. I don't think that's it. But what I did want to do is I wanted to sort of leverage and use this great system that has developed in America, system of accountability, yes, in defense of taxpayers' rights. And I think it's been, again, we've been in this field for 15 years. It's been very diverse, very interesting. Again, focusing mostly on tax planning, transactions, also tax audit. And again, very rewarding, very interesting sort of career. And I encourage, if there are students in the audience that are considering tax as an option, I encourage students to consider this. All right. So over the past 15 years, and again, going back to this very, very broad topic, there are certain recurring themes that I have observed in my practice. And so it is those themes that I want to highlight. They may seem very basic, they may seem very generic, but they come up so frequently that I thought this could be a useful forum to raise those issues, those themes. And again, feel free, if there are questions from the audience, feel free to ask them. All right. And one of those, I apologize, I'm going to start sliding. This is our little agenda. This is a very ambitious and a very small slide, right? General business advice. What I want to highlight, and actually when we're discussing with this presentation with my colleagues, what came to my mind was that often I observe clients being, I would say, overly focused on tax. Yes, tax is very important, right? For every dollar that you earn in your operations, you stand to lose 50 cents in taxes to federal and state governments, for sure, right? Tax is very important. But I've observed, because it's so important, in the mind of some operators, tax becomes the thing in itself, right? The business becomes not about business, it becomes about saving taxes. And I think, unfortunately, again, as a tax practitioner, saying as tax practitioner, as important tax is, business does not exist to save money on taxes. That is not the point of the business. And I've had those conversations where a client would come to me and say, I have this great idea, and we're going to do this, this, and this, and we're going to get tax credits. Like, yeah, okay, tax credits and what, right? Tax credits and what money, right? Because tax credits is a fine sort of supplement to your operations, but the primary driver for those operations needs to be generating cash, right? Generating cash. If you don't have income, good news, you don't have to pay tax, right? So if your business is failing, you don't get paid taxes because you're not generating income. The driving focus of a business is to make money. And actually, the initial version of the slide was to make sales, right? To raise revenue. That's not all of it, right? We say collect receivables. It sounds very basic, but yes, you need to make sales. You need to collect receivables. This is sort of the most fundamental thing that you need for the business is to make money. Nick, anything on that?
I've dealt with in my career a number of places where they were very sales oriented, especially the salespeople. And but if you didn't collect that receivable, you were better off not making the sale.
Why is that?
Because you have the cost of that sale that went out, and if you don't collect the receivable, you've lost what went out of your cost. And so, many businesses understand this, and that's why when you go to McDonald's, you pay first, right? And so we've had some issues that, with clients in the past where why are they failing business? Well, you look at their balance sheet and you see, well, you've got this much inventory and you have this much accounts receivable. Why is that? Because if you could just get all that money collected, well, now you can make all of your payables and your payroll, and all of your suppliers are happy, and you are much happier as a owner. if you collected your receivables.
Yes, and also,
And excuse me, I could just beat on this forever, but back to you.
form of business, right? Form of business, type of legal entity could also be relevant in this analysis, right? How?
Well, I mean, the corporation, or if you're a partnership, or how, you know, those the losses would pass through or not, and those types of things tax-wise.
Yeah, so you could be in a disadvantageous situation from tax perspective if you don't collect your receivables as well, right?
Well, right, because now you're in a loss situation, you know, how does that save you money, right?
So the other kind of a super obvious bullet there is deferred gains, right? And by, you know, the income, when we think about income, we need to distinguish between what amounts to operating income, right? Income from the operations, and that you're pretty much stuck with that, right? There is not a whole lot you would do. If you're running a widget factory, you're making widgets, you're selling widgets, you're collecting your receivables, you're gonna have taxable income, you're gonna have to pay tax on that. Now, the planning, really most of the planning is around capital gains, or around the built-in gain in an asset. That gain, in effect, would be the difference between the fair market value of that asset right now, whatever the asset may be, maybe a piece of property, maybe a stock or interest in an entity, and the tax basis in that entity. Basically, roughly speaking, what you paid for the thing minus depreciation, right? So that built-in gain in the asset, when it is realized, right? Because when your house appreciated from $250,000 to $500,000, you feel richer. Your net worth had gone up. That the value is realized, but it's not, since you haven't sold it yet. It's not recognized yet, right? It remains deferred in the asset. And so there are very limited provisions in the Internal Revenue Code that allow to engage in transactions that defer gain, right? So the most classic example in real estate, you can, if you structure the transaction as an exchange, you can dispose of your asset. Under general tax principles, whenever you dispose of an asset, it's a recognition event, it's a sale. You're exchanging an asset for what? For money. It's a sale. And in case of a sale or exchange, you must recognize gearing, which is the difference between the tax basis, the value of the asset and the tax basis. That's sort of a baseline scenario. You can, the gain can be deferred in the case of a disposition of an interest in real estate. It can be deferred if you structure the transaction as a 1031 exchange, meaning what? Meaning you roll it over, right? You roll over your investment. You haven't sold the thing, you didn't walk away with the cash in your pocket. If you have cash in your pocket, if you can go to the beach, if you went to the beach to drink margaritas, right? That's how we know that you terminated your investment. However, if you roll your investment, maybe from one piece of real estate to another piece of real estate, in case with stock, right, with properly structured stock transaction, you can roll over investment from your investment from investment one corporation to another corporation. Again, very, very sort of strict and narrow rules. If you follow them, then this exchange, if you will, one asset for another, one stock for another stock, can be tax-free, not necessarily tax-free, but tax-deferred. Okay, it can be tax-deferred, meaning that the value, this recognized or realized but unrecognized gain in this particular asset or stock can be deferred to be recognized in the future later, but not always. In what circumstances, maybe I'll ask this question to Ivan, in what circumstance do you no longer have to pay tax on the increased value on the built-in gain? That's a tough question. But I'll give you a hint. You have to pay a very high price for it. Very
Can you repeat the question?
Yes. What makes built-in gain go away?
Well, I think I don't know. I can think of two methods, right? How to make gain go away. It can be either we can go into estate planning, right?
Okay. So with proper planning, and actually it's a very interesting observation, right? With patient planning, right? With deliberate planning, any gain that is built in the appreciated asset can be deferred basically either forever or nearly nearly close to forever. Okay, close to forever don't make a difference, right? So, in some real sense, built-in gain, right? Gain in an appreciated asset, paying tax on that is optional. It's optional. With planning, you can absolutely avoid that. Okay, so plan for it. Was that one?
Yes, that right.
Okay.
Plan for it.
Yeah.
And then also, I don't know, maybe using it as a leverage for debt.
Okay,
And-
so it's the same. Yeah, what you're getting at is that you can, the asset appreciated, so you actually can refinance, so you can get cash, but you haven't sold it, so there is no gain event, right? There was no disposition of an asset, so you can, in effect, leverage it, you get cash, you get money, you can use it for things including your living expenses, but since you haven't disposed of the asset, there's no recognition event. That, of course, has to be repaid. But it's an access to liquidity without sale. Nick has another answer, right? How do you avoid paying tax? Built-in gain. Die. And in kind of in a high net worth planning sort of environment, there's this phrase, buy, borrow, die, right? Buy, borrow, die. Well, why? Well, buy, you just keep buying real estate because white always appreciates in value. Borrow, because as Ivan just mentioned, that as real estate appreciates in value, you can keep borrowing against it, right? Including to finance your business operations or way of life, or whatever. And then die. What's so magic at this right now about death? Well, that built-in gain, the difference between tax basis and value, it evaporates, it disappears on death. Why? Because your heirs will inherit that asset with a stepped-up basis, with a basis that is stepped up to fair market value. So all the built-in gain is going to be gone. The heirs will increase appreciated asset. In my example with the house, $500,000. Tax basis will be $500,000 upon death of the parents, because the children receive an asset with stepped-up basis. All right. So buy, borrow, die. It's kind of a nice catchy phrase, good to remember. So defer gain, right? So don't sell asset. If you don't sell asset that is increasing in value, appreciating, well, then you're not gonna have a gain event. You defer the gain. Again, with a very openness that applies to investments, right? It has to be investment, either real estate or stock. If you roll over the investment, you can defer the gain basically forever.
Question?
Yeah.
So you're saying, so once the person passes away, fortunately, right? But the family, they don't have to pay taxes unless they sell, or no?
Yeah, no. So in my example, right, the value of the house right now is $500,000. In dad's hands, the value of the house was $250,000. Built-in gain is basically half of that, right? 500 minus 250, 250 per example. But upon dad's death, the child inherits the house. Tax basis becomes 500. The child can sell the next day for zero gain. He'll have $500,000 in cash, but zero gain. Okay, so that's the concept of the stepped-up basis on debt. Now there could be estate taxes, right? But right now, the estate tax exemption, the amount that you can pass to your children or to your heirs without any gift or estate tax, that amount is pretty high. Who knows that number? Maybe I'll ask Ivan again. What's the sort of estate tax exemption right now?
It's 12.9.
12.9 million.
From now to, they have it set on 2026. They may change even go back to 7 or 5. So
yeah,
plan before the 26.
Right. So right now the estate tax exemption per person is 12.9 million.
Yeah.
So for married couple it's twice that, right?
Correct.
So it's whatever 25.
Unless you're a non-citizen.
It's a good point. It's a very good point, right?
Unless you're a non-citizen, like at 60,000 you start.
Yes. Yeah, and I want to say is it if not just non-citizen but a not tax resident.
A non-tax resident, more specific. Correct.
Right, and I think you can be a non-citizen but tax resident.
Correct.
Yeah. And it's very hard to be in United States and be non-citizen and die in the United States. It could happen. It's hard. It's hard because to become a tax resident, I think the test is you need to spend something like 6 months in the United States in the last 3 years, and it's people like maybe professional athletes get in trouble becoming tax residents without wanting, but most people who live in the United States will be tax residents in the United States. All right, so deferred gain, right? And here I also want to mention the concept of a kind of legal entity or choice of entity. And I'm just mentioning again, sounds very, very basic, very fundamental, but I talk to a lot of clients kind of in a family business context, and they forget that there's such thing as a legal entity. Because remember, in most cases, most businesses, what are your options, right? If you're going to do business, what are your options? You can, this is from business law class, everybody knows that. You can do business as a sole proprietor, right? You can form a legal entity. Your legal entity options are in California LLC, corporation, whatever, limited partnership, and I think that's about it, right? And so the reason why you want to form a legal entity is really a non-tax reason. You just want to limit personal liability, right? If in the course of your business, you make some kind of mistake, you get sued, you don't want to lose your house, right? You may have to lose everything you invest in the business, but not your house, right? So that's why you put the business into some kind of limited company, LLC, corporation, something like that. Okay. Well, that legal entity is a separate legal person. Okay? That legal entity, in many cases, not always, is a separate tax person, right? It has a separate existence for tax authorities or for the courts or for the just general legal system. Okay? But business entrepreneurs, business people tend to forget about legal entity. They think, I own this thing. Okay? You don't own this thing. You own a legal entity that owns that thing, right? So it becomes very, very important. And why is it important? It is important when, especially when you're thinking through transactions, right? When you're thinking through transactions, when you're thinking about selling, what are you selling, right? I want to sell a business. Okay, what does it mean? What's your business, right? What are you selling? You're selling in effect assets, right? Or you're selling interest in a legal entity, which could be, again, LLC in most cases, or corporation. Okay. And I ask a good question. What's the difference for federal income tax purposes? What's the difference between LLC and corporation in the context of a small family business?
Well, usually people, when they form an LLC, they form it either as a single member LLC or as an LLC that has multiple members, and they want to have it treated like a partnership. And so therefore, if the entity makes profit during the year, the entity does not pay any tax, but it passes it through on a Schedule K-1 to the owners, and then the owners would report that typically on their 1040. Where most corporations, or large corporations, are what they call a C corporation. And so anything that you see, traded in the stock market or anything like that is a C corporation. And so, let's take the biggest, Apple, and that's a C corporation, and they make their profits and they pay income tax each year based on their profits. And then if they pay dividends to the shareholders, then the shareholders would pay income tax on the dividends that they receive. So it's
two levels of taxation.
Two levels of
In case it was
taxation,
straight
or
to-
double taxation as people call it.
Straight to Chapter C corporation, you have to worry about two levels of tax, one at the corporate level, and then one as a dividend at kind of a shareholder level.
Right.
So that's very important. And that kind of interesting point, on this point, in real estate, you don't often see corporations. Why?
Because of that.
Because of that.
Because the asset, when you buy real estate, you buy it with your plan, right, for the real estate to go up in value. Corporations, you don't want to double tax that, right? Where if you buy equipment, or if you buy automobiles, or you buy, so many other things that you do use in business, you expect over a relatively short period of time that the value of that thing will go down as you use it up, or it becomes, no longer the great car. I can remember as a kid getting a Mustang, '66 Mustang, and that was a great car.
Do you still have it?
I do not still have it. Should have kept it because it's worth more now than it was brand new. But that car really isn't as good of a car as a car that's been produced in the last few decades. Right? It's the same with equipment.
Right, again, you need to be aware of the type of entity that your business, that holds your business, right? It's very important because you might have multiple levels of taxation in case if it's a corporation. And again, you will need to ask yourself, but it's going to be the next slide, we're going to talk about that actually as well. Going about that. When you contemplate exiting, right? What are you selling? Are you selling assets? Are you selling interest in a legal entity such as a corporation, a stock, or LLC interest? And again, once you answer that, what is the consideration you want to get paid? Right? We already discussed that. If you will get cash, so you can go on the beach and drink margaritas, that's a taxable event. If you don't get cash, if you get something else. Right. What is the something else? If you get stock of the purchasing corporation. In a classic example, if there's some Silicon Valley garage startup, right? The seller has the entrepreneur has a brilliant idea. The value of the business is now on, take a number, $50 million. The big giant corporation Apple wants to buy it from him. Well, if this entrepreneur sells his business, whatever the structure that is, for $50 million in cash, it's going to be a major taxable event. Half of that is going to disappear. Okay? But he might say, I don't want to sell it for cash. I'll take Apple stock. Apple stock really is almost as good as cash, right? You can easily sell it. So he said, I'll take Apple stock. That becomes a tax-deferred transaction. The basis in the stock is going to be zero, which is basically the basis of the business that he's selling. Basis in the stock is going to be zero, but it's not. The gain is preserved in that stock, but it's not recognized until that entrepreneur sells a sliver of that stock for some smaller portion. Yes, that portion is going to be taxable. Yes, about half of the value is going to go away in taxes, but not the whole thing. So. Again, what are you selling? Are you selling business assets or business LLC interests? What are you selling for cash? Cash is almost always going to be taxable. You could sell for installment note. Now, the great thing about installment note is what, Nick? What is the good thing about installment note?
The gains inside the note.
Yeah.
And so until you collect the principal on the note, you don't have a taxable event for the sale. Now, the interest that you collect on the note, that will still be taxable as interest income. But, so you sell your business for $100 million and you take back a note and, so you get to pay interest on the $4 million or you pay tax on the $4 million of interest you collect each year. But until you start collecting the principal on that $100 million, you don't have to pay tax on that.
Yeah.
Once you collect the principal, are you taxed as a capital investment, or?
Yes, the principal would be the payment of principal. When you collect principal, it's going to mirror the nature of the asset you sold. So if you're selling a capital asset, then the sort of built-in gain in a note is going to yield capital gain at the time when you collect the portion of it. Okay, good question. Now, and so kind of an interesting point. If you have an installment sale, right? In effect, the rules tell us that, and I'll describe it my own way. I don't think how the rules are written, but in effect, what you do is you allocate your basis. Remember, your gain is the value minus your basis, your tax basis. Well, if you're getting the cash payment up front, all of that amount is recognized right now. Okay. But suppose you're getting a payment, equal installments over 4 years. Right? That's sort of your deal. Okay. In effect, you take the basis, and that's equal installments, and you allocate it equally over the next 4 years. Right? And so in each year, you receive an amount of money. You will deduct, right? You will reduce that amount of money by your sliver of basis allocated to that year, and pay tax on that gain, right? And so you will pay each time you collect the money. You will reduce that revenue or those proceeds by the share of basis allocable to that year. Pay tax on that each year. Okay, it seems pretty non-controversial, right? It's a decent sort of a tax planning technique. The downside, right, you defer cash, right? You defer cash, you defer gain inclusion of it, but also you don't get all cash up front, which is maybe okay. Now here's the interesting thought. What if your sale is structured as an earn-out? What's an earn-out? What's an earn-out? Maybe somebody from the audience can help us. What's an earn-out?
Let's ask ChatGPT.
Huh? Oh, yeah. I will ask Nick. Nick, what's an earn-out?
ChatGPT.
It's sort of the thing where you look at the performance of the business after the sale to pay for the purchase.
Yeah. So I'll tell you a story. I worked on probably the biggest transaction I worked on. It was ConocoPhillips sold its Canadian business to a Canadian oil company, Cenovus. The sales price was $10 billion plus contingent consideration of $5 billion. This $5 billion was contingent consideration. And it's a great example, right? Because the lots of zeros make it impressive, but for right, it doesn't really matter, right? For family business, it doesn't really that huge to be meaningful, right? But this example is great. And so it was pretty clear that the $10 billion was received pretty much immediately. But this contingent consideration was somewhat complicated. What was it contingent on? Well, it was contingent on oil price. So the agreement basically said, okay, well, the next 5 years, actually every quarter, we're going to test the oil price. And if the oil price exceeds a certain amount, then you're going to get a sliver of that $5 billion as a payment that quarter. If it doesn't exceed that amount, you're not going to get it. And so forth, right? So you're testing every quarter. Every quarter, if the oil price exceeds that amount, you get the payment. If it doesn't, you don't get the payment. So this becomes the interesting point is this, that you have no idea, right? You know your maximum possible amount, in this case is $5 billion, okay? But because the sort of obligation to pay that amount of money is pegged to something as volatile and unpredictable as oil price, right? It makes it challenging for you to plan for that. And generally speaking, installment sale rules would require you, right, to allocate, in my example, a third of your basis, right, a third of your basis to the future 5 years, right? In my example, the sale price is $15 billion, 10 received right now, 5 is this contingent consideration. So you would take a basis allocated into, in effect, 2/3, which you recover right now, and then the third of your basis allocated over the next 5 years. Well, that stinks, right? Because suppose your basis is, I don't know, $3 billion. If you have to, you get $10 billion right now, 1/3, $1 billion is allocated to the future years, $2 billion allocated to right now, so you actually have to pay tax on 10 minus 2 equals 8, right? What you really want is you want to be able to recover all of your basis right now. So you really want to pay tax on 10 minus 3 equals 7, right? And then again, seems small when you just say the number 7, but if it becomes included in taxable income, it's a huge number. So the question then, can a taxpayer take a position that all of the basis, all of the $3 billion basis in my example should be recovered in year 1, in the year of sale, and not spread out over the next 5 years, when maybe I'll get some money, maybe I won't, which depends on oil prices that nobody absolutely can control. Well, and this is what we have with the open transaction, right? And basically what it says, open transactions, I have no idea. Right? Your taxpayer says, I have no idea what I'm going to get until I get it. Can't predict, can't model it out. There is not a reasonable way to sort of discount that cash flow because who knows what it is. I have no idea what amount is going to be. So I'm going to, in effect, pretend that I'm going to get nothing. In the future, I'm going to recover all of my $3 billion basis. I'm going to pay tax on 7. And if I get a payment in the future, it's going to be fully taxable. And if I don't, then there'll be nothing. But the point being, I recover the basis right now. So again, if it's the And you got to be very careful with this because the service hates this doctrine or this approach of a transaction because they say, well, you should be able to estimate it. Well, if you don't know, ask an economist, right? Again, to have a consultant tell you the value that you expected to receive. But nevertheless, taxpayer can take a position that the sort of likelihood of payment is so small that I don't need to allocate any basis to the future payment. All right. So next bullet there, mergers and acquisitions, and again, this is that is the situation where the seller, right, the entrepreneur desiring to sell the business, sells business not for cash but for stock of the acquiring business. I would say it's incredibly unusual, rare in Central Valley. I think I don't think we have public companies coming to sort of and buying businesses with public stock. It could be though in a closely held business. I mean, it doesn't have to be a public company engaged in this type of transaction. In effect, again, the seller is selling the business in exchange for stock, right? For stock of the buyer. Lots of caveats, lots of rules, but properly structured. That exchange, again, remember I told us it before, in exchange of anything for anything, baseline is a taxable transaction. Properly structured exchange of business for stock of the buyer can be tax-free, tax-deferred transaction.
Do people usually get an IRS acceptance of the program? That's on a merger acquisition, or is it that clear?
I think well, so I think you're thinking about some kind of advanced ruling. Yeah. People do, on very big transactions, people do. It's expensive, right? You have to write the letter to the IRS and you have to pay a processing fee. And there are some areas where IRS will just not rule. They will just not rule. They say, read the code and take a position, right? So yeah, there's ruling that is available. But no, it's completely unnecessary.
So if you're an advisor, what do you do? If you give the wrong advice, you may be in trouble.
I mean, I don't know. Sure, yeah. I mean, you could be in trouble. There's such thing, actually. It's a fairly recent thing. It's a tax insurance.
Oh.
So, but again, if an advisor feels good about transactions, so if it's a, I don't know, shoot, right? There's a high likelihood that the taxpayer would win on audit. The taxpayer actually can choose to acquire tax insurance such that in the off chance that taxpayer does lose, then the sort of money to pay the shortfall actually comes from insurance company, which is very interesting. I recently found out about that, and I'm intrigued by the concept. But yeah, so it becomes sort of the taxpayer and the taxpayer's tax advisor need to understand the rules, understand the facts, and structure the transaction in a way that follows the rules. So advanced ruling is not necessary. It could be a good idea. It could be a good idea, but it's definitely not necessary. All right, so we mentioned already exchange, right? We mentioned exchange before, and again, we're talking about exchange, the 1031 exchange, when a person is selling real estate and acquiring like kind of real estate. That exchange, even though it's a sale, right? It's a sale, properly structured. It can be a sale that does not result in recognition of a built-in gain. Now, and I said the word like kind, and it's basically the word is, and yes, the rule is to be like kind of real estate, but basically, I would say, and I hate being overly generic, almost any real estate is like kind to almost any real estate in the United States. Okay, there are rules, extensive rules, but you can sell apartment building and buy a pistachio ranch, for example, and vice versa. You can buy open land, sell open land, and then buy again apartment building, pistachio ranch, mineral rights, that kind of stuff. So the challenge, though, if for example, if we're talking about exit, right, business exit, if an owner desires to sell apartment building, and he doesn't want to buy another apartment building. He just wants to sort of go passive, right? Wants to get out of the business of managing apartments. Well, you can exchange. What am I going to exchange into? I don't want to, I don't want to do anything, right? I don't want to do anything. I'm ready to retire. I'm ready to receive a check in the mail. That's all I want to do. So there is this fairly kind of a recent structure that allows purchasing interest, whether amounts to a beneficial interest in a Delaware statutory trust. It's being a beneficiary of a Delaware statutory trust, in effect, acquiring beneficial interest in Delaware statutory trust amounts to acquiring interest in real estate. And again, it's a fairly new thing. I think maybe 20 years. Somebody kind of suggested as an approach. Actually, got a ruling from the IRS. The IRS said, "Sure, okay," and it became a very widespread phenomenon. But basically, yes, you can sell your real estate, and this Delaware statutory trust could be giant. It could own billions of dollars of real estate, and it can fashion sort of your share, if you will, this beneficial interest according to your requirements in terms of how much interest you need by value and how much equity you bring, because you might have a debt in the apartment building, right? So you might have your equity might be less than the value, and when you do the exchange, you have to match both the value of the replacement property and the equity that you have in the replacement property. So the acquisition of a beneficial interest in the Delaware statutory trust can be structured in a way that sort of satisfies both of those requirements and achieves a completely tax-deferred transaction. And this Delaware statutory trust is basically, and I hate using this analogy, but basically like a real estate investment trust. It will own real estate for a number of years, maybe 7 to 10 years, will sell it, and then there's going to be an opportunity to roll with that investment into the next real estate investment. But basically, what's the point here? The point here, it's a way, right? It's a way to dispose of kind of like actively managed real estate in favor of kind of a passive investment where you're kind of getting my check in the mailbox, right? In a way that's tax deferred, right? Tax deferred. That's sort of the point.
Okay, so question on the floor. Yeah, sure.
How is the Delaware statutory trust treated on death? Do you get a step up in basis like you would on?
Yes. Yeah. There would be a step up in basis in that interest on that. Yeah.
So that's a highly technical question for those in the room that are not accountants.
Yeah, so you die, right? Is there, because we mentioned before that, right, if you, death of a taxpayer results in a big step up in basis in the assets that the taxpayer owns, step up to fair market value, right? So this is just going to be a type of real estate asset that tax basis of which steps up to fair market value, thereby eliminating the built-in gain we discussed before, the built-in gain that we want to defer. Okay. And so again, I'm just kind of going to very super generic general business advice slide. I would add another bullet there. Remember there's a legal entity, right? Remember that your business is likely owned through a legal entity. You should understand legal and tax characteristics of that legal entity in order to plan your really anything, any day-to-day transactions, and also any kind of future disposition exit transactions.
Okay, Ivan, touching on the legal entities, and you have emphasized like 2 times already how important it is to understand that there's a legal difference between the legal entity and the individual taxpayer. Now, for example, what happens if I own an LLC and real estate, has some real estate assets, but I do, instead of using the checkings account from my LLC, I use my personal checkings accounts to I don't know, make a AC unit for one of the real estate assets that I have.
So
is that a breach of the
it's a very interesting question, right? So I think if I understand you correctly, Ivan, what you're saying is that you might have a business owner, an entrepreneur who cleverly set up an LLC to manage and limit his liability, right? And the real estate is actually owned by that LLC. That's great. But the real estate, the apartment building requires some repairs. And so the entrepreneur says, well, okay, the apartment building requires some repairs. So pulls out personal checkbook, right? Personal checkbook in which family funds are kept. And he writes a check to pay for those repairs. Is that a problem? All right, well, I would say it is. Is it a tax problem? Maybe. But why is it a problem, right? The whole reason why we create legal entity is to say, hey, you know what? It did it. I didn't do it. Yeah, I own it. Yeah, I'm a manager of it, but I didn't do it. The legal entity did it. So if somebody in an apartment building falls on the stairs, breaks neck, and sues me, don't sue me. Sue the thing. Sue the LLC, right? The point is to say, hey, I'm the owner, not liable for it. LLC is liable for it. So you can get whatever insurance proceeds. You can even take the building, but that's the most you can take. You cannot reach my personal assets. Okay. But for that result to be the case, you must follow corporate formalities, okay? You must respect, as the owner, you must respect the legal entity, because if you don't respect the legal entity, guess what? The court will not respect the legal entity. And so commingling, right? Commingling things between personal and business is a great way to undermine the existence of legal entity. Okay, the concept is called piercing corporate veil, and so yeah, somebody gets hurt on your property, you'll get sued. You'll say, I didn't do it. The owner of the apartment is a legal entity. Recover from them, and they'll say, yeah, you know what? Look at this. You used your personal checking account to pay business expenses. You know what? You are not treating this apartment building as being owned by a legal entity. You yourself acting as its owner. Therefore, we're gonna pierce the corporate veil. We're gonna collapse the legal entity. We're gonna pretend it doesn't exist. You have to sell your house to pay this claim. So it's an issue, right? It's an issue, and I think that to some degree, again, it could be. I can see how it could be a tax issue as well. But in a base case scenario, when it's a single member LLC, tax doesn't matter. Single member LLC doesn't exist for income tax purposes, but it's a flow-through entity. It's a transparent entity, disregarded entity. So there is no tax issue in that case. But yes, it's very important. Again, this is sort of why I want to emphasize. Remember, the entity is there. Respect corporate formalities, both for the benefit of tax and non-tax considerations. Right. Good question. All right. So. All right, so we're going to touch a little bit on estate planning. Right? And it's obviously also an incredibly broad issue. People in the audience might know a lot about that, but by all means, feel free to ask questions or chime in to sort of add and elaborate. But what's a trust, right? First of all, what is a trust? We have first bullet, the revocable trust. What is a trust? The trust is a legal arrangement that only exists in countries that borrowed legal system from United Kingdom. It's a basically old British common law concept. It doesn't exist in other countries, non-English common law countries. They're usually called civil law countries or common law countries. United States is a common law country. It exists here. Now, what is a trust? Trust is a way to hold property that splits responsibilities and enjoyment of property ownership. So think of an example, a car, right? What is the privilege or enjoyment of a car? You get to drive it. What is the responsibility or burden of owning a car? Well, you have to pay insurance. You have to take it to a mechanic once in a while. You have to pay registration and so forth, right? So there are two things. Enjoyment is driving the car. Responsibility is maintaining and paying car expenses. Okay. So a trust is a way to hold property. In my example, a car, that in effect separates legal title and beneficial title. Again, title conceptually as a legal sort of abstraction, as a legal concept, is a right to particular property. So the right to particular property is split in two. In a trust, it is split in two. And beneficial enjoyment is given to one party, we'll call it beneficiary, and the responsibility, the burden of owning it, the responsibility to pay registration and change oil goes to the trustee. Right? The person who sets up a trust is the trustor or grantor, right? That's the person who's sort of giving the thing. The legal owner, right, for all legal purposes, trustee is the owner, and then the trustee is the one who has the burden of ownership. And then the beneficiary is the beneficial owner, again, gets to enjoy the thing. Okay, so the trustee and beneficiary both own the property. Trustee, in effect, has the duty to manage it. Beneficiary just gets the duty of privilege. Right. So what's a revocable trust? Revocable trust is just that. It is a kind of a shell, if you will. Almost like an entity. It's not an entity, but it's an arrangement wherein the trustor, the guy who sets up the trust, or grantor, same person, beneficiary and trustee are one person, right? During the life of the trustor, this trust can be revoked, right? If I can put an asset into the trust, I can take it out, right? Why? Because I'm everything. I'm a trustor, I'm a trustee, and I'm a beneficiary, and I'm alive. It means I can put stuff in, I can put stuff out. What would be a great example, right? Why is this revocable trust concept is widely used in really individual personal financial planning? Because it's a great way to pass your house to your children. Because maybe I'm going to take a step back, right? Suppose I die, right? What happens to my house? My house is, suppose I took title, Ivan Caldwell, right? Who owns the house? Ivan Caldwell owns the house. Well, Ivan died. So Ivan Caldwell doesn't exist anymore. Whose house is it? Well, by operational law and perhaps by my will, the house goes to my children, my 4 sons. So my 4 sons go to a county assessor, recorder assessor, and they say, father died, here's the death certificate, we changed the title of this house to our name. Well, what will the recorder assessor say? They'll say, well, I need a court order, because your father is the only one who can change the title. And he's dead, so he's not available. So you need a court order to instruct me to change the title from your father's name to your name. Okay? And that's called what? It's called probate. Right? The process wherein the court retitles the assets, such as real estate assets particularly, from the dead relative to the live children, is called probate. Okay, the probate, and I don't know how long it takes these days. Back in the time when I was doing that, when I was practicing law at a law firm, it was 7-8 months, right? Maybe it's a little bit quicker right now. So a long time. There are attorney's fees, actually, by probate code. There are attorney's fees that are built into the statute that my children now are required to pay out of the estate in order for this probate to be settled, right? It's a burden, and especially if the only asset is the house, well, they're gonna have to come up with some cash somehow. Okay? So the attorney fees, time, and just administrative hassle. Okay, all why? Because I died and I'm unavailable to sign this document to trust the house to my children. Okay. Well, what's a trust? The great thing about trust is that it doesn't die. The trustor sets up a trust, and again, if it's a revocable trust, the person, me in my case, is the trustee, beneficiary, and grantor. Three offices. Well, once I die, the trust will say, I'm appointing my brother-in-law to be the trustee, right? So the trust continues to exist. There's a dedicated, designated person who can sign documents in the name of the owner of this house. The owner of the house is the trust. The trust didn't die. I died. So my children then come to the uncle and then say, hey, you know what? We want to retitle the house to our name. No problem. He has the authority to sign the house over from the trust to their name. provided the terms of the trust permit it, right? And so no probate, no attorney's fees, no 7 months, no hassle, right? So everybody, I would say, I'm just looking at the audience, everybody who has a house should have a trust. Okay, baseline, right? Baseline. Everybody who has children should have a estate plan. But anyway, so revocable trust, again, why you can set it up, you can revoke it, you take the gift out. Intentional defective grantor trust. Yeah, you might have heard that. This is a irrevocable trust, right? It means that, yes, trustee set up, yes, there are beneficiaries, presumably my children, but this gift cannot be taken back, right? It's irrevocable. I put a house, put an apartment building into this trust, I lost all rights to it. It's a completed gift. The trustee, who obviously is going to be somebody I like and trust, probably the same brother-in-law, he has all authority, all legal authority to sign documents and act in the name of the trust in the best interest of my children, the beneficiaries. I lost control over it. Okay. Now, why we're saying intentional and defective grantor trust? Well, grantor trust meaning what does it mean? Again, it's irrevocable trust, and the reason it's made intentionally defective is because that apartment building is going to be kicking up revenue. Who's paying income tax on that? Well, I can set up the trust in such a way that I, the dad, pay income tax on that. Why would I want that? Well, I don't know. Maybe I want to reduce my estate. Remember, which is not the case, but the exemption right now is $12.9 million per person. For a couple, it's whatever, 25 and a half. It's a pretty big amount, right? But there could be a situation where I want the value to be building up for my children, and I want to be eroding the value of my estate to get below the threshold. So I don't mind paying tax on operating income of the trust. I don't mind paying tax because it doesn't deplete, this tax doesn't deplete the wealth that my children are creating, and it further depletes my wealth, which is just as well because I'm trying to get below the lifetime exemption amount. It's pretty perfect, right? And why is it intentionally defective? Because I want it on purpose, and it's actually intended to be punitive provision. The tax code was written in such a way, okay, because the tax code doesn't trust, right? Whenever the transfer between parents and children, the tax code is looking at it suspiciously. You're trying to play the system. And so the tax code says, okay, if you do this, and this, then we're gonna treat this trust as if it is, even though it's a completed gift for estate and legal purposes, we're gonna treat the trust as if, for income tax purposes, as taxable to you, the debt. I say, perfect. I'm going to violate those rules on purpose so that the trust income is taxable to me, the dad, thereby eroding my estate further below the threshold amount. Again, with the current amount, $25 million, not such a big deal. 20 years ago, it was $1 million. It was more widely used. I have a question about that.
Yeah, that amount that you're mentioning, the 25 million to 12 million, there's actually a sunset clause on that. In 2025, it's going to drop down to about 6.2. With that being said, what advice do you have? Is there any way, if any advice, to get around that? Like we're talking about deferring it, or like 1031s and 1035s, that kind of stuff, to kick that can down the road?
Well, so there's a couple of observations. So in the history of estate tax, there's always been exemption, I want to say. Or at least whenever there was an exemption, it never went down. So over the years, it was going up. It never went down. And so at least the commentators that I follow, they say, you know what, it sunsets in 2026, but because estate tax, also known as death tax, is so crazily unpopular, there will be likely no political will to bring that exemption down. Likely it's going to stay there. Maybe currently it's indexed for inflation, maybe the index for inflation will turn off, but likely it will stay high. So that's sort of that comment. Another comment, yeah, make your gift right now, right? Make your gift right now, because if you make a gift right now, again, remember this exemption amount applies to what? It applies to, it's same number, but it applies to two things. Either lifetime transfers or transfers at death, right? So you can, right, as an individual taxpayer, pass to your heirs $12.9 million without any gift or estate tax consequence, right? So you can make a gift right now a lifetime. If it's again, some exemption, some amount. If you're giving it to the children during your lifetime, then it's you're reporting it as a gift. There'll be no tax. It's going to be sort of.
But they don't get the separate basis.
Well, sure, yeah, exactly. So
You don't get the separate basis
for sure.
as you would at death.
Correct, right? So if you set up a grantor trust, irrevocable trust, you actually can transfer to your children right now during your life $12.9 million of value, right? And that's it. If exemption goes down next year, it doesn't matter. You have achieved your goal. That's not yours anymore. To your point, that basis will not step up on your death. Why? Because that stuff is not yours. If it's an irrevocable trust, it's no longer yours. It's outside your estate, right? That's a good thing. But there is no step on basis. What's more important to you? Step up in basis for your children or getting out of your gross estate? I think it's a question of math and modeling, and you can probably figure it out.
And with the, like you say, major gift now, and I agree, and I've seen that go on. Are you doing that with an irrevocable trust? Is that the way to get out of your estate?
Yes.
Okay.
So irrevocable trust is its own separate person. So any gift to your irrevocable trust is, I cannot take it back, I cannot call it back, it's a completed gift.
Okay.
So it functionally already went to my children, right? But because the trust will have terms, right? The trust will have a trustee, the trustee who has the responsibility to manage the trust, and maybe I don't trust my children. They're small, the oldest one is 12 anyway, right? So I don't want him to have everything. Maybe I don't want him to have everything ever. Maybe the income of the trust can be paid to my children, but not. I want the principal, the apartment building itself, is stuck in the trust as long as the rules allow me, which is about 100 years in California right now. But the gift is completed, right? Because that's a gift to irrevocable trust. And right now, if I do it right now, then I've taken advantage of that exemption. The flip side of that, when I die, there is no step up in basis because that stuff is not mine anymore. Okay. Alrighty. So we have the comment.
There's another thing you can do.
Huh?
Let's have the income reserved. Have an income reserved to the donor. That asset then is brought back into the donor's estate, on which the tax will be imputed.
The asset is broken into estate, not just the income?
It's a retained life estate.
Okay.
Yeah.
So, very good. There are estate planning techniques that are available to consider these issues, and we will not go into that right now.
Yeah.
But just trying to highlight the issues. Now, the question might be life insurance. Why am I saying it there? Well, would you be so? I wish that I was so lucky, right? If you're in a situation where you may have to pay state tax, where's the cash going to come from, right? Where's the cash going to come from? Because suppose you own farm land or apartment buildings. If you're in a state tax-paying position, there will need to be cash coming from somewhere to pay, and you could sell the assets. That's kind of lousy to pay tax. Then you kind of sort of sell on the legacy you want to pass to your children. Life insurance is a great instrument. You can sort of model out and project what your estate tax liability may be, and acquire life insurance, term insurance, to help manage that exposure, that estate tax exposure. Right, and so we have under estate planning this captive insurance concept. It's a little broader, but I'm going to ask Ivan. Ivan, can you sort of help us introduce this topic of captive insurance?
Sure. So captive insurance, right? Sorry, what's your name, sir? The one with the cameraman?
Jaguar.
Okay, well, I would choose you. I'm sorry, I hope you don't feel bullied. So let's pretend, right, an example. Let's pretend that the cameraman, has different entities, right, within the the filming industry. Maybe one of the entities is focused on filming here in Fresno State. One of them is its main operations is outside filming for a news station, and another company is doing independent films. Right now, those are affiliated companies to his main business, to his business. So a captive insurance company is an election that you can make under the Internal Revenue Code 831B, which allows to form an insurance that can provide coverage to your own or to its own affiliated entity. In this case, if you selected to be captive or micro-captive 831B, you are not taxed on any underwriting income. Well, there is a threshold, which is I think 2.65 million currently for 2023. That underwriting income is any premiums that you receive minus expenses or claims that were due through the fiscal year, and then the rest is the income, right? So under 831B micro captive insurance, you're not taxed on that income below the threshold, but you are taxed only on the interest income, right? Let's say the pool of premium that you have, you put it to work on different funds or different operations. Any interest that produced from there, they are taxed, but not the premiums that you're receiving. That's the basic captive insurance. Right now, they are formed to cover. I don't know. Maybe in the filming industry, there is no open market insurance that covers for a breaching contract of an actor. Right. Let's say you have already paid and make the expense to make a film, and then out of the last minute, the actor said, "Hey, I don't know, I have COVID, I won't be there." Okay, now you lose the revenue, and there's no insurance that covers you. Then your captive can offer those policies, right, that are not easily acquired on the micro captive. on the open market insurance. So now, when it comes to estate planning, right, when we talk about captive insurance and estate planning, is that if you have kids, right? Let's say you have 4 kids, they can be the owners of the captive insurance. So now you're transferring wealth while you're alive, in the means of premiums to them that are tax deferred or tax free. Tax deferred, we'll say, right? Right. So you won't be paying taxes on that, on those premiums, and you will be passing your wealth to your kids or to the next generation. And at the same time, if I'm not mistaken, you can also, write up insurance expenses on your current operations.
Yeah, so because you can, because the affiliated operating business is buying insurance, right? It's buying from the captive insurance, but it's real insurance, insuring real risk, and so ordinary necessary business expense, you get to reduce your income at that rating business level. That income that related to the premium is actually reported, those dollars are reported at the captive insurance. But because of the threshold that Ivan mentioned of $2.66 million, the captive insurance can collect $2.6 million of revenue from who? From a related entity, from an affiliate, right? Who took a tax deduction for that? The captive insurance can collect $2.6 million of the revenue and not include that. I mean, it's going to be on tax return, we're not hiding it, but it's just not subject to any tax at all.
Yeah, no income tax.
No income tax, yes. Whatever investment income is generated by investing those proceeds, you're gonna have to pay tax on that. But not on the premium itself, up to $2.6 million, which is pretty amazing, right? It's pretty amazing because that you're paying insurance premium, getting a tax deduction, you're getting it here, you're not paying tax on that, you're investing and it's going to grow, and if you set up ownership structure such that it's owned by your children, for example, or the trust for the benefit of your children, then it becomes wealth accumulation in the next generation, okay? So it provides a service to your operations for insurance coverage and shifts wealth and builds wealth in the second generation without really, there's no gift anywhere in this structure, right? Because it's an honest to goodness business expense. Okay, any questions?
So can you kind of give
practical examples of how family businesses would use captive insurance? Are they setting it up on their own? Are they working with companies that do captive? Are they getting, how are they getting creative to use captive?
Sure. Well, so for sure you will need an advisor, for sure. And there are companies that provide kind of custodial services for captive insurance companies. Yes, you own it, but because they are highly regulated, basically it's obviously all but impossible to sort of manage it yourself. There are custodial companies that, and I think maybe even against the law, I don't know, but there are custodial companies that will help you form it. They will actually write premiums. The policy is a real policy to write policies. They will do kind of a study to determine, what's the actuarial, what a premium should be. So you're working very closely with pretty much a dedicated advisor in this structure, right? Again, the family or the children or children's trust are going to be the owners of it, right? But it is a very close relationship with the custodian company. And yeah, I think that really the question is, do you have the kind of risk that can be insured? In a farming context, it could, really in any business context, it might be earthquake insurance, for example, right? We have earthquakes in California, it's a legit risk. Maybe it's too expensive to buy it in open market. Now I'm gonna set up captive insurance company and paying premiums to myself, right? The challenge though is that there are two concepts that need to be met. And it's risk shifting and risk distribution. Risk shifting and risk distribution. And so it requires multiplicity of entities in your structure, right? If you only have one entity, setting up one captive insurance company probably will not work. I think because each entity is its own legal person, having multiple entities will sort of create this appearance, even though they're owned by the same family, right? It will create the appearance that we're actually shifting risk from one person to another, right? And distributing it among the several entities within the kind of a common group of ownership. So I think it is useful to, I guess, not just larger businesses, but businesses with a larger entities in the structure. And yeah, it's not something you can do yourself. You would need to reach out to a captive insurance custodian company who will walk you through the process.
Yeah, if I may extend on that again also, yeah, I think, working with an advisor that is an expert on captive insurance is like highly recommended, and that's the only way that I would advise. I mean, I'm not in a position to advise, but I would advise someone to enter into this agreement for different reasons. There have been, I don't know, I think at least 4 major cases, between captive insurance companies versus IRS. And the IRS, everything that looks like magic, I have discovered during this internship, everything that looks like magic, the IRS doesn't like it, right? So the captive insurance, I mean, it's like magic, right? Like you can transfer the wealth to the next generation, and you can take a write-up, expense currently in your operations. So the IRS is really focused on these transactions, on the micro captive transactions. So they recommend, right, that as long as the financial benefit is a secondary product of the main insurance, you should be set, right? Like you have to make sure the main reason, or under federal law, the main reason of creating the captive is not for the financial benefit, but because you need insurance, yeah, for your wells, for your cameras, for whatever your industry is. Now they also have to be like well capitalized. I don't think anyone, well, at least I don't like undercapitalized companies, right? That you have to, in a captive insurance, you have to meet the requirements for the jurisdiction, right? Every jurisdiction have their certain. Okay, you have to keep. I don't know. I think Hawaii is like $250,000 on liquid capital.
It's too low. You're saying it's too low.
Yeah, and I think it's too low. Yes, I think it's too low, right? But the IRS is going to also require you maybe to hold at least, like whatever, if you have a claim, to be able to hold the capital to fulfill your obligation, to pay your claim. So yeah, it has to be well regulated. but it's really an amazing technique.
No,
to use.
it's a very good point. IRS hates those, right? IRS hates those. Obviously, they're legal, right? But they need to be properly structured. And as I will point out, IRS will be looking for problems. Oh, it's thinly capitalized. It's not. It doesn't have the sufficient equity to meet its insurance obligations. Obviously, very important to monitor that. And there have been. There have been, in the last few years, there have been many cases of IRS attacking the structures and winning. Now, that said, is it risky? Yes. Is it beneficial? Yes. The point being, as Ivan said, right, it needs to be real insurance. Meaning, if you insure some I don't know, anti-terrorism insurance, right? Well, I mean, is terrorism a real threat in Fresno, California? I don't know, right? Maybe it is, maybe it isn't. But if you wouldn't buy it, but from your own insurance company, it's probably not real insurance. So it needs to make sense. It needs to have the appearance of a legitimate.
You know what I mean? Another example is like there is this case. I forget the point is, but the company was paying on an the annual insurance expenses, I think, on $60,000 or so, and 1 year after creating the captive, they were paying like 200 and something thousand on insurance.
So to the third party, to unrelated third party, the market, they were paying $60,000, but
to their captive, they were paying like 5 times the open market.
So it suggests something other than real insurance, right?
Correct.
You're trying to shuffle money from here to there, right? Yes. So yeah, there you go. All right. So and actually, wanna.
So just real quick, so at the end, like let's say that I close the business today and the captive insurance fund has not been used because thankfully there's no dirt tax in Fresno. So what happens to those funds? Can I just disperse them and then?
Well, so the captive insurance companies tend to be highly regulated. It is an insurance company, right? And so it needs to be regulated, and you'd have to work with regulators. But yeah, you would wind it down. You probably have to keep it until your policies, because your policy might be multi-year policy. So once the policy obligation is fulfilled, yeah, you can liquidate it. And that money is going to go to the owners, who presumably in the structure are going to be your children's trust.
Right.
And so that's the value that got built up for the benefit of the second generation. And they can distribute whatever. It's their money. They can do whatever they want.
Or the employee.
Okay, yeah. Okay, maybe or employees. You got it. Right. So wanted to add something here. Freeze transactions, and then there's this phrase. The first kind of a catchy phrase was buy, borrow, die. Right. That's the kind of one sort of a estate planning technique. Another estate planning technique is also has a catchy phrase, and that's squeeze, freeze, and bleed. Squeeze, freeze, and bleed. And in the context of this, I'm going back to a couple bullets up to the intentional defective grantor trust. The way the kind of a sort of tax planning technique could work is this trust, this funded with an amount of money. Okay? That amount of money is likely to be, particularly if we're talking about a wealthy family, right? Really wealthy family. It's funded up to the exemption amount, which is right now $12.9 million, right? So the gift is made, right? So the dad makes a gift of $12.9 million to the trust. Completed gift at exemption amount, no gift taxes. Okay, perfect. Then, but that owns $200 million of real estate. So the trust then used that money to buy the real estate. In fact, all of it. All $200 million. Well, how can it do it? Well, it's gonna borrow money. It's gonna use the $12.9 million I just gave it as a down payment, and it's gonna finance the rest. Who's it gonna borrow money from? Well, from me. I'll loan the money. And what's the price? Right? What is the price at which this asset is sold? And again, let's say I said real estate, maybe it's a good example. Maybe it's actually a minority interest in an LLC, which owns real estate, which will appreciate. So I go to a valuation specialist and I say, well, I have this building. Well, we have this building. And really, the value of my LLC units is $200 million if you just look straight percentage of interest in the LLC to the value of the building. But my percentage interest in the LLC is small, it's only 20%. What can we do? So the valuation expert will say, perfect. You don't control this particular LLC. So we can give you discount for lack of control. Also, it's a closely held business, hard to sell, so we'll give you discount for lack of market. And so what otherwise somebody might say the value of this interest is $200 million now becomes discounted. Right? It becomes discounted by 20% for lack of market, another 20% for lack of control. So it becomes now, help me out, $120 million asset, right? And so I sell this, and I have an honest to goodness valuation report. I have it, so I can prove the value. And it'll say $120 million. And so I'm selling this interest to the intentionally defective grantor trust in exchange for the cash I just gave it, plus a note, plus financing. So now I'm holding a note. Cash, well, maybe I need it for expenses, which is fine, but I'm holding a note. So my estate is now frozen, right? It's frozen because note will not increase in value. Real estate will, and therefore, indirectly, the value of the LLC units that just passed on will increase in value, but the note will not, right? So it's freeze. Squeeze bit is that by value in this minority interest in this LLC, with a lack of control, lack of market discount, I was able to squeeze the value from what it otherwise might have been, $200 million, to something less, right? $120 million. Just squeeze, freeze, and another word is bleed, right? Because it's structured as intentionally defective grantor trust. The income generated by this asset now in the trust for the benefit of my kids further reduces my estate, right? The $12 million I took back, well, I have to pay tax on that, so it further reduces my estate. So really, by the time I die, the only asset in the gross estate is going to be the note, right, which is valuable. I have to pay estate tax on that. But in hopefully 40 years, when I die or so, the value of the trust is going to be many times over what the value of the asset at the time of transaction, thereby again shifting wealth from me to the children and freezing my estate, right? Freeze, squeeze, and bleed. We're discounting the value of the interest, we're freezing it with a note, and we're bleeding it further by, in effect, having me pay tax on the value earned by my children. And there's a similar transaction that's called a family limited partnership, and Ireland will tell us about it.
Correct. Family limited partnership is also another instrument that we can use for tax planning, right? When transferring wealth to the next generation, to your kids. Now, going back to to cinematic productions over here, LLC. Let's suppose he has a estate of 50 million, right? Let's go for 50 million. Now, by creating a family limited partnership, he can transfer his asset of 50 million into this partnership, acquire 100% interest, and then dividing this interest between controlling and non-controlling interest, or voting and non-voting interest. Now, going back to his 4 kids, he can now transfer 24.9% non-controlling interest to each of his 4 kids, and he keeps the remaining 4% right, of controlling interest. So now he, as a general partner, he still has control over the asset. He has control of the operations, whatever direction he wants to take his business towards. And now the limited partners, in this case the kids, they are enjoying the passive income. However, they don't have the control, right? So now the valuation discount, like Ivan was saying, is an important factor in this arrangement as well, because now the non-controlling interest, it has less value than controlling interest. For the lack of control, right? You don't have control. It's hard to. It has to have less. Is worth less, right, than controlling interest, and the lack of marketability, right? Like if I have Apple stock or Microsoft stock, I can sell it as it's liquid, it will sell in microseconds. If in Fresno, if I want to sell something that I'm not controlling, interest in a partnership that I'm not controlling, it will be hard to sell. It has the lack of market. So, you can apply the 20% of discount on lack of control and 20% or 15% discount on lack of market. And now the asset, right, we did say 50 and then 25, so that $12.5 million for each kid. Now, if we reduce, 30% as a discount, now it goes to 8.7, 8.75. So now you froze, right? You freeze it here, freeze the value, freeze the state. Now, whatever appreciates, it belongs to the kids, the appreciation. But as when it comes to estate tax, you're already gifted. You're already passed to your kids, so you don't have to. That appreciation of your business doesn't belongs to you anymore. It belongs to your kids.
Yeah. So it's basically very, very kind of similar concept to I have a $50 million apartment building. And I only have between my wife and I $25 million lifetime exemption. What do I do? So I form an LP with a partnership. I break up the difference between voting and non-voting. Right, most of the value is going to be non-voting, but I would say 99% plus is going to be non-voting. I keep the control though. I contribute the asset into this entity, tax-free transaction, and then I discount the non-voting shares, right? I go to the valuation professional, he'll say, you know what, I said 30% discount. Well, that's enough, right? If I discount the value of $50 million by 30%, it gets me below the threshold. So I in effect, achieve the same result. I give the asset, those LLC units to my children or their trusts, right? I was able to discount them because they're non-voting shares and they're less than 50%, so there is no control. And I basically was able to reduce the value of my apartment building from $50 million now to the value of 4 individual slices of shares of the partnership, valuing $12 million, $9 million each, which brings me at my threshold. So. Also very powerful technique again, it's the same catchy phrase, it's a squeeze, discount the value, freeze, so your estate doesn't grow anymore, the future value goes to the children, and then bleed through the grantor trust structure, you continue to pay tax on the earnings that endure now for the benefit of your children. All right, good. And so just in terms of succession planning, you guys had separate discussions about that, but I'm focusing on operating agreements, right? Particularly in family businesses, right? You might say everything is great, we're getting along great, we're always going to get along great. We don't need the operating agreement, right? And what's an operating agreement? It's basically a contract, right? It's a contract between investors in an LLC, how they're going to make decisions, how they're going to distribute earnings, blah, 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 right? Just got to be what happens when one of them dies, what happens when one of them wants out, right? All of those things should be thought through early, immediately upon formation, really, whether it's a family business or business with other partners, but plan for the worst, right? Because relationships change, people age, people die, and new people come into the business. There's absolutely no guarantee that they're going to get along well. So just make arrangements as early as possible to make solid operating agreements that predict basically everything, right? Any possible terrible scenario that could happen, it should be predicted, so plan for the worst. All right, so that's all I have to say about anything else, friends here? No? Okay, so we'll go to Q&A. Have any questions? I think we're right on time. Questions?
You did a great job.
All right, thanks.
All of you.
Okay. Yeah.
I have a question. What do you guys recommend for a small startup to keep track of their sales? Like what kind of an app or?
Of sales?
Yeah.
QuickBooks sounds good.
QuickBooks is a place to start. Hopefully it's not where you end.
Oh, okay. Right.
You want to
Also,
grow beyond QuickBooks.
any other questions?
I do.
Yes.
What questions do you wish more family-owned businesses would ask you? The things that they're so focused on here now, perhaps there's some longer-term things where you're saying, yes, you're thinking like a fish in a small bowl right now,
Yeah.
but if we change this, like, you could be a bigger fish.
So, well, those are different things.
Yes.
But I would say what I wish family businesses understood is A, how to read a balance sheet, including debits and credits, and understand that in most cases, they don't own assets directly, they own them through a legal entity. The incredibly frustrating sort of fact of dealing with entrepreneurs is inability to understand balance sheet and double entry system of accounting, and inability to acknowledge that the business they own, they don't own, they own LLC interest that owns the business. It sounds incredibly fundamental. Many conversations could be avoided if those fundamentals were understood. Right. Well, I'll put my email back on a slide. I have a business card. Feel free to ask me questions. I do have a practice on the side, so I'll charge you money for it. Okay.
Good. And I will go ahead and forward Ivan's information to everyone. Thank you, panelists. Thank you, Ivan, for sharing your conversation. I just want to take a quick moment to recognize our board members today. Rob Katka, one of our board members, supporter of the Institute for Family Business, our legacy board member as well. Fred Reese, thank you for making all of these seminars possible with your guidance and contributions as well. And just as important, we have some students that are the next generation here. And I'd like to thank you for participating in today's event. If you can just stand up a little bit. I know it's so we have the next generation accountants right here, some data analytics people. So thank you, Julia with data analytics, and Paris as well in the back. A couple of our FPSA members had to leave for a final test coming up. But these are the faces that are going to take over in the future, and so thank you for being invested in the knowledge at this point. And thank you, folks. There's still cheese outside. If you have any questions, feel free to ask. If not, let's hope that we can still converse either here or outside. And thank you once again for connecting with Fresno State.